Welcome to the Deep Dive. We're the show that tries to pull out the really important nuggets of knowledge just to help you stay genuinely well-informed. Today, we're zeroing in on something that frankly causes a lot of anxiety for investors. This pervasive fear, that rising interest rates are just like a guaranteed threat to the stock market.
You hear it all the time.
You really do. You've seen the headlines, I'm sure. The S&P 500 took a bit of a slide at the start of September, nearly 0.7%.
Yeah.
And right away, everyone points the finger at rising rates.
Yeah.
We saw the U.S. 30-year yield get close to 5% recently.
Which analysts often treat like some kind of financial boogeyman, right?
Exactly, whispering about equity doom and gloom.
Yeah, that 5% barrier seems to be the magic number for concern.
But what if that widely accepted truth isn't quite so true?
What if the history tells a different story?
Precisely. What if it's actually a surprising story? That's our mission in this deep dive. We want to challenge that narrative. We're pulling insights from a really illuminating analysis by Lucas Downey over at moneyflows.com. His article, Equities Thrive Amidst Rising Rates.
A pretty provocative title.
It is. So our goal is to look at the historical evidence, show that equities can and, often do thrive in these supposedly bad environments, and then, crucially, figure out what you should really be focusing on instead of just rates.
It's kind of amazing how deep-seated this idea is, isn't it? This, knee-jerk reaction. Rates go up, stocks must go down. You see pundits day after day treating every little uptick in yields as, a major cause for concern.
Right.
That recent 30-year yield hitting 4.97%, a two-month high, that definitely sent ripples through the commentary.
You're bringing up that 5% barrier again.
Exactly, as if it's this cliff edge for the market. But when you actually step back, look at the decades of performance, the narrative, it starts to unravel. Quite a bit, actually.
That's really the core of it, isn't it? It feels like this conditioned reflex.
It does.
Yields rise, markets must fall. But what Lucas Downey did at Money Flows, it was powerful. He went back through the data meticulously.
Yeah, looking at how stocks actually performed, right?
Yes.
Across different rate environments.
Exactly. He dissected both the 30-year and the 10-year Treasury yields, going all the way back to 1978.
That's a lot of data.
It is. And what he found, it's genuinely eye-opening. It completely flips the script on what many of us, have been led to believe.
Okay, so let's dig into that. Starting with the 30-year Treasury yields. They're often seen as that long-term barometer for borrowing costs.
Right.
So looking at weekly data, again, since 1978, the S&P 500 performance history is pretty telling. Now, as you might expect, when 30-year yields were low, like 3% or lower, the S&P did well.
Okay, that makes sense.
Yeah, an average 12-month return of 11.8%. That part fits the conventional wisdom, Cheaper money helps companies grow, boost stocks.
Okay, so far so good for the old narrative. But here's where the data takes a really fascinating turn.
This is where it gets interesting.
You'd think, naturally, as rates climb higher, returns would start to suffer.
Right? Well, it's the assumption.
Yet even when those 30-year yields moved into that middle range, say between 3.01% and 5%, large-cap stocks still did well, pretty darn well.
How well?
Average 12-month gains of 9%. Not exactly the doom and gloom people talk about.
No, that's still quite solid.
And this is the part that really stands out for me. Even when 30-year yields broke above that dreaded 5% level, an environment often painted as, perilous, the S&P 500 still averaged a gain of 10.7% over the next 12 months.
Wow. So almost as good as when rates were below 3%.
Pretty much. So the takeaway here, the bottom line from this data, it's a direct challenge. Don't sell stocks just because long-end rates are rising.
It seems the historical evidence just doesn't support that fear. Equities have shown this consistent resilience.
Often thriving, even.
Exactly. Yeah. Which suggests other factors are usually more important. Maybe stronger economic growth, which often happens alongside rising rates, is driving earnings higher.
Right. It's not just about the cost of money.
It seems not. And this isn't just some small blip in the data. It's a significant historical pattern we're seeing.
It really makes you wonder, doesn't it? How many investment decisions are being made based on this gut feeling that the data just doesn't back up?
It's like that alarm bell goes off interest rates.
Yeah.
And everyone ducks, even if it's, maybe a false alarm historically.
Yeah. And the analysis didn't stop at the 30-year, did it? The bears, they've also been rattling the cage about the 10-year yield rising.
That recently spiked too, up to 4.27%.
So what does the data tell us there? Is it the same story?
It's a very similar counter-narrative, actually. Looking at the monthly data for 10-year yields, again back to 1978, when 10-year yields were low, below 2.5%, the S&P gained an average of 12.4% 12 months later. Pretty good. Interestingly, the lowest average returns were actually found when 10-year yields were in that 2.51% to 5% range.
Lowest meaning.
Still an 8% average gain. So hardly a market meltdown, right?
Right. Still positive. But what about when they climb even higher? Above that 5% mark for the 10-year, which, again, is often framed as a major red flag.
Yeah, a warning sign for the economy, for corporate borrowing costs.
How do stocks react then, historically?
Well, if we connect this all together, even when 10-year yields break above 5%, historically, the S&P 500 has gained 11.3% in the following 12 months.
So very similar to the 30-year result.
Exactly. This historical data just flat out contradicts the idea that high interest rates are an automatic stock market killer.
So the article's conclusion?
It's pretty definitive. There's no practical correlation between high rates and equity performance. Equities can, and often do, withstand high interest rates.
That really puts a dent in the anxiety we see everywhere. It suggests maybe investors are barking up the wrong tree, focusing solely on rate movements.
It certainly seems that way based on history.
Okay, so if the interest rate story is, well, potentially misleading, what's the real compass for an investor trying to outperform?
Good question.
If we shouldn't be fixated on rates as the main driver, what should we be looking at to generate that alpha, to actually beat the market?
Well, this is where the money flows analysis shifts gears completely. It suggests looking not at the rates, but at where the money is actually going.
Following the money flows.
Precisely. This is where their methodology really comes into play. Instead of just reacting to macro headlines, they focus on tracking real-time institutional capital flows.
How do they do that?
Their system tracks and ranks nearly 1,000 exchange-traded funds ETFs every single day.
Wow, okay.
It's this unique systematic approach. It lets them spot these powerful flow trends, which often last for months. It gives investors a kind of map showing where big institutional capital is piling up.
So it's about watching what the smart money is actually doing, not just guessing based on economic news.
Exactly. Observing tangible behavior, not just interpreting abstract indicators.
And we can see this happening right now.
Yeah, the article gives a very recent example. Just yesterday, September 3rd, 2025, their system picked up 12 distinct ETF inflows.
12 specific funds seeing money come in.
Right. And when you unpack those inflows, look at the themes. You see some consistent trends emerging.
Like what?
There was healthy buying, as they put it, across specific areas: materials, silver, gold, communication services, and also some broad total market funds.
So what does that tell you beyond just a list of sectors?
Well, it tells you that even if some investors are feeling fearful or uncertain, capital is always moving somewhere. It's looking for opportunity.
It doesn't just vanish?
No. These inflows aren't random. They represent deliberate choices by institutions. Seeing money flow into materials and precious metals like silver and gold alongside comm services, it suggests a dynamic market. Capital might be seeking perceived safety in metals, or maybe strong growth stories in comm services, rather than just pulling back entirely. It hints at conviction in specific areas, regardless of the broader noise.
And you mentioned gold specifically. That seems to have been a recurring theme.
Yes, what's fascinating here is that gold has been a really big, consistent theme in their data. The article even mentions they advised readers to buy the dip in gold way back in May.
So this isn't just a one-day thing?
Not at all. It's a persistent trend their system has been tracking, showing sustained institutional interest.
Okay, can we get more specific, like an actual example?
Absolutely. They give a fantastic concrete example. The VanEck Gold Miners ETF, ticker GDX.
Okay, GDX, gold miners.
And the article points out something pretty incredible about this fund. Get this. It hasn't seen any outflows in 2025.
Wait, 0 outflows all year?
0 outflows. Think about that. Every single trading day this year, capital has only entered that fund. Non-stop inflows.
That's pretty powerful.
It really is. It signals immense, consistent institutional support. It's a testament to the power of tracking these flows. For you as an investor, that kind of sustained trend is a massive indicator of underlying strength and conviction.
Okay, that's a huge signal for the ETF itself. But how do you then jump from a popular ETF like GDX to finding, the specific stocks within it that might be the real winners.
Ah, right. Because an ETF holds many stocks.
Exactly.
This is where the money flow system drills down even further. You can use it to find those potential outlier stocks within those high inflow ETFs.
How does that work?
So they don't just stop at the ETF level. They rank and score all the individual stocks inside those ETFs. Each stock gets a weighted MAP score.
MAP score.
Yeah, it's their proprietary measure. It basically indicates a stock's overall appeal to institutional investors based on technicals, fundamentals, and those all-important money flows.
Okay.
So for instance, GDX itself currently has a pretty strong MAP score of 53.9, and that's broken down further into a strong 59.1% technical score that suggests positive price action, good trading activity, and a solid 46.4% fundamental score, reflecting the underlying health of the companies in the ETF.
So it analyzes why the money might be flowing in.
Precisely. It goes beyond just it's popular to it's popular and it looks strong technically and fundamentally, according to their metrics.
Got it. And crucially, they don't just give you the score for the whole ETF, right? They highlight specific stocks.
Exactly. They profile the top-ranking names within each tracked ETF. This makes it much easier for you to potentially find those individual outliers, the ones really attracting institutional dollars.
So in the GDX example, who are the top names?
In GDX, the article highlights the top two: Agnico Eagle Mines, ticker AEM, and Alamos Gold, AGI.
Okay, Agnico Eagle AEM. What do the signals show for that specific stock?
Well, take AEM. The system flagged it as having nonstop inflows. They mark this with green signals on their charts.
Green means buying.
Green means consistent buying pressure, institutional accumulation. But even more compelling for AEM, it's been showing up repeatedly on their Outlier 20 report.
Outlier 20, what's that?
That's indicated by blue signals. The Outlier 20 report is basically their list of the top 20 stocks across the market showing exceptional institutional interest and, based on their model, a high probability of continued outperformance.
So AEM wasn't just getting inflows, it was hitting this special outlier list multiple times.
Correct. It's not just a one-off spike in interest.
Yeah.
It's consistent, sustained institutional backing. Essentially a strong vote of confidence from the big players.
This really raises an important question then for you listening. How can understanding these capital flows give you a more reliable map than just reacting to those broad market fears about rates?
Yeah, it seems like a much more proactive approach, doesn't it? Rather than just reacting.
Totally.
And that's exactly the point the article makes. The power of this system is that, and I quote, no matter what worries investors are facing, capital is flowing somewhere.
Always finding a home.
Right. So by focusing on these specific data-driven signals, the MAP scores, the green signals for inflows, the blue signals for outlier status, you're essentially looking at where the smart money is actually deploying its capital. It gives you this tangible, observable map. It can guide your investment decisions, arguably much more effectively than just reacting to the latest headline about interest rates or, frankly, any other general market fear. It's about using systematic analysis to find real opportunities.
Okay, so let's bring this all back together. This deep dive, looking at the money flows analysis, has really shown us that the common belief rising rates equal trouble for stocks is seriously challenged by the historical data.
Yeah, strongly challenged.
In fact, stocks have often done quite well, even thrived in high-rate environments. And the real map for investment success, according to this analysis, isn't found by staring at interest rate charts.
Probably not.
It's found by identifying where that institutional capital is actually flowing. Pinpointing those high-ranking outlier stocks in specific themes, maybe using a system like the one at Money Flows.
Following the money, not the headlines.
Exactly. So here's a final thought for you to consider. Thinking about how often conventional wisdom, especially in finance, gets overturned by data.
Yeah.
What other widely held beliefs out there might be limiting your perspective, limiting where you look for true opportunity? Perhaps the biggest risk isn't really the headlines or even the rates themselves.
Maybe.
Maybe it's not looking beyond those conventional narratives to see where the genuine capital flows are actually pointing.